If there's one word that sums up Bitcoin and other cryptocurrencies, it's volatile. Crypto prices rise quickly and then seem to fall almost as quickly, while rumors, sentiment, and real-world changes are quickly taken into account by the market. In April 2021, for example, the value of Bitcoin hit an all-time high of more than $64,000. That didn't last long. 3 months later, the cryptocurrency had lost more than half its value, dropping to under $30,000. In November 2021, Bitcoin hit an all-time high of almost $69,000. By the end of January, it had lost more than 40% of its value. That volatility draws in traders who want to make money, but it can be scary for new investors who want to start out. There are going to be a lot more of these highs and lows in the future, because new cryptocurrencies are going to come out and others are going to fade away. With cryptocurrency being so volatile, what should investors be doing to keep their money safe? When cryptocurrencies fall, here are 5 things to do. Scared by a fall or excited about the chance to buy a house for less? When cryptocurrency prices fall, here are 5 things you need to do to keep your money safe. 1. Stay calm. To sell your cryptocurrency or buy more when the price drops, you need to keep your cool. Making decisions based on your emotions, especially when you're trading, doesn't usually end well. People who want to trade crypto might want to think about why they want to do it first. There is a long-term chance, but are you investing because you think it is worth it? Is this where you come to make a quick buck on short-term trading? If you know the answer to these questions, you can make the right choice. It doesn't matter which way you go, you should act in the direction of your own goals. If you believe in the long-term chance, think about it that way. If you're just here for a quick trade, think about that. 2. Assess the situation. Is there any news that is making Bitcoin and other cryptos rise or fall in value? It's possible that there is important news that has changed the market's mood, and it's not just price action or rumors that are making people feel that way. In the big drop in Bitcoin prices in 2021, real things may have made prices go down. Since China already banned crypto exchanges in 2017, the country's move to ban financial institutions from providing crypto-related services was a second clampdown. People could still own cryptocurrencies, but they couldn't use them. Late in 2021, the Federal Reserve decided to cut back on the amount of money available in the financial system. Since then, many cryptos have taken a big hit. So these moves have been even more bad news for the growing market, which had been getting a lot of money. 3. Remember that volatility is the name of the game. When it comes to cryptocurrency, it changes all the time. There is no cash flow coming out of crypto, so traders have to rely on changes in sentiment to move prices. In that case, the market can go from being excited about things all the time, like it was in early 2021, to being very pessimistic, like it was a few months after that. In 2021, there was a lot of excitement about the Coinbase IPO. At the end of 2021 and the beginning of 2022, there was a lot of pessimism about crypto because the government cut back on monetary stimulus. So if you have an asset that's driven by sentiment, you need to know that the emotions of traders move the market, so you need to pay attention. As for stocks, that's true too. But they may also have a real stream of growing money flow from the company that owns them. This volatility is what draws professional traders. They use high-powered algorithms to make complex trades, which mom-and-pop traders don't usually have the chance to do. There are a lot of people who like volatility because it gives them a chance to make money. That's what Wall Street is all about. 4. Think about the future. Is China's ban on crypto a sign of things to come? Maybe. A lot of people in India and Russia don't want to ban cryptocurrency, and they're not the only ones. But other countries, such as the United States, may choose to regulate cryptocurrency rather than ban it. In the future, it's not clear how other major countries will deal with cryptocurrencies. But it's clear that cryptocurrencies face real threats in the form of regulation, even regulation that could put them out of business. Cryptocurrency is becoming more popular, but it could become a victim of itself. Because crypto is used in ransom attacks and other crimes, it doesn't help that crypto is used. So it's not out of the question that the utopian dreams of people who sell crypto could be made illegal. Of course, the political implications are only one part of their long-term plans. Crypto has a lot of other problems, like the costs of mining them, which are both money and bad for the environment. Another risk. Because of their volatility, many cryptocurrencies are mostly useless as money, and they're being sold to people who don't want to use them as money. 5. Determine how to act. In the next step, after you've calmed down, you'll think about how to act. In other words, are the risks really opportunities disguised as threats? If you think that way, you might want to keep your current position or use a drop in the price to buy more. There are a lot of things that could happen. Is that true? If so, you might want to take your losses now and stay out of the game for a while. Does the situation need to be more clear up? Consider selling some of your stock today, but not all of it. You'll still have a chance to make money tomorrow. You'll need an action plan that shows how you think about the risks and opportunities of cryptocurrencies, no matter which way you go. The smartest investors in the world won't touch cryptocurrencies, and they'll tell you to stay away from them, too. Charlie Munger, the vice chairman of Berkshire Hathaway, said, "I like the Chinese, and I think they made the right choice, which was to ban them." Don't forget to subscribe to our channel.